Today, we're going to talk about how to read these 8 portfolio, like these metric tiles here. Okay, so we've talked a little bit in the previous days about the builder itself, the portfolio generator, and the manual builder. And obviously, when you're picking a portfolio, trying to figure out what direction you want to go, lots and lots of choices. We still have this 549 strategies loaded and millions, hundreds of millions of possible combinations, right? And so today we're going to focus again on these tiles here, what they are and what they mean. So let's start with the first one, net profit, which is pretty self-explanatory. I assume this is all your gross profits, all your wins minus your losses, and then probably also takes into account the commissions as well to kind of give us that net. Is that correct?
Yes.
The net. Okay. And then your maximum drawdown. A lot of people don't know that don't have a solid definition of drawdown, but drawdown is basically it's like your highest high to your lowest low. Like what is the biggest up and down you might see in an account? And it's probably it's hard to see on this chart, but it's probably like from right here to down here, right? And if we were to zoom in, obviously this would be way more exaggerated, but the highest high to the lowest low. And I don't see anything else kind of quite that size. So I'm guessing somewhere in this general area was that max drawdown. And it's telling us that our account value went down 43.13. And that is super important because obviously you want your drawdown to be a ratio of your profits. At least I like to. I don't like to risk $10 to make $1. I'm okay risking 4,300 to make 232,000. That makes sense. And then obviously tracking this, we're going back to all this entire portfolio is back to January of 2022. You guys can see here little bit small, but January 2022. And so we're going back from the end of, or I guess the end of May of 2026 back here. So about almost 2.5 years. And then it averages out like what is the average monthly? Now, keep in mind, obviously, you guys all know average isn't really a thing. There's extremes that are added together, right? Sometimes it might be high, sometimes it might be low, but this is just average over the last 4.5 years. And then our profit factor, we'll talk about in a sec. And then the only thing else I want to touch on real quick is the win rate, which is when you win, like how often do you win, how often do you lose? And a lot of people get so obsessed about this number and this number only. They like 80% plus, and that's great. But I've seen 80 and 90% plus systems also lose as well, right, Tracy? You've seen high win
Yes.
rates lose. And the reason that this by itself as a single standalone statistic isn't really tell you a lot is when you lose, when you lose, how much do you lose? And when you win, how much do you win? And that right there is literally what our profit factor is kind of telling us for that 0.39 means for every dollar that we lose or every a dollar of risk, we're going to make $1.39. That's what the profit factor is. Now, you're like, Matt, is that per trade? No, that's actually averaged over 4,515 trades. So we like to think of it like we call it a sample size. Obviously, when you're running a test like this, going back in time, looking at a specific strategy and going back for 4.5 years, it's important to know that we're not looking at like the last week and only looking at the last week. We want enough of a sample size to give us a good enough or a big enough collection and sampling for that to give us some confidence in the results that we're seeing. Again, win rate by itself, everyone's like, "What's the win rate? What's the win rate?" But just as a quick example, and I feel like a broken record when I tell this example, so if you go to let's say you pull up a chair at any table game in Las Vegas, and let's say you have, I don't know, blackjack, whatever, pick a table game. And for every time you win $25 and you have a 90% success rate. You're like, okay, that's pretty good. But when you lose your house. So in that example, when you win, you make $25. When you lose your house. How many are excited about a 90% win rate? No one. Why? Because that one time, that 10% chance is totally devastating and brings you to your knees. And again, that's why the win rate by itself isn't nearly as important. Just it's a statistic. It's not important by itself as a standalone. That's the only criteria I'm looking at that a lot of people ask us about. So yeah, that's kind of the first six here, the first six stats. And Tracy, tell us a little bit more about the Sharpe ratio and the recovery factor.
All of these are just one data point on their own. So it's always important to take everything into context, and it's the combination of all of these that create the context. So
Right.
that's an important factor. Now, a lot of people will think that Sharpe factor and profit factor are kind of telling the same thing, but they're not. Sharpe factor is more of um, it's how much return that you're going to receive based on the volatility that you're experiencing. So it's kind of a measurement of how smooth is the ride.
Okay.
Okay. So whereas the profit factor is how much am I gaining for the dollar, for every dollar I'm risking, how much am I getting in return? So Sharpe factor is kind of measuring how smooth that ride is. And when you get to recovery factor, that's just it's a multiple basically. If you take the net profit and divide it by the max drawdown, you're going to get 53.85. That's what that number means. So basically, you are getting 53 times the return for the risk.
Right.
Yep.
So it's the ratio of like this divided by that,
Yep.
essentially. Right.
Yep.
Got it. And this 232,000, obviously, when we built all these portfolios, we're using a, let's see, where is it at? We're using a 50K account, right? So you're like 50K to 230K of profit. That sounds really, really interesting. But what you might not realize is you can get a funded account for literally $130. There's some that are more expensive, some that are a little cheaper, but imagine paying $130 for the 50,000. And so the ratio of how much did it actually grow, it's assuming it started with 50,000, but it only cost you 130. So that ratio as a percentage, 130 into 232,000, or obviously you might have multiple accounts that you want to run this on. That's 130 into 232,000 is a significantly better return than just 50,000 to 232. And what we're going to do is we're going to click on this button right here and we're going to send it to the analyzer. We're going to take a look. We'll spend more time on this in future class, but here's our ups and downs. And this is basically every single month, 1 month at a time. And we're going back to January of 2022. So we're going back 4.5 years. At this moment, we're early June, and you'll see right over here is January 2022. So going back 4.5 years, essentially, right? So that gives us a lot of data points, a lot of months, and our average is, somewhere right here, right just below that $5,000 level. And as you guys can see, many times it goes above. This one was kind of our extreme, but very minimal drawdown relative to, a very nice month. And you can mouse over each one of these, and I'll tell you that this is a $14,000 month. So again, if we were to go back into the builder itself, you'll see here that we have, let's delete some of these. Yep, we got, our $4,300 average.